Today we're diving into the world of safe investments. You know, those places to stash your cash that keep it secure, but maybe leave you feeling a little underwhelmed by the returns. But what if I told you there might be a hidden gem, an ETF that tracks ultra-short treasuries, boasts minimal risk, and potentially offers way more bang for your buck than a traditional savings account? Intrigued? We're talking about SGOV, the iShares 0 to 3 month Treasury Bond ETF. In the next few minutes, we'll crack open this ETF, explore its ins and outs, and see if it could be the secret weapon your portfolio needs. Stick around. What is iShares 0 to 3 month Treasury Bond ETF SGOV? The iShares 0 to 3 month Treasury Bond ETF, ticker symbol SGOV, is an exchange-traded fund, ETF, designed to provide investors with exposure to short-term US Treasury bonds. Here's a breakdown of what SGOV offers. Investment objective. SGOV tracks the investment results of an index composed of US Treasury bonds with maturities of 3 months or less. By investing in SGOV, you're essentially gaining exposure to a basket of these short-term treasuries, offering similar returns to holding the individual bonds themselves, but with the added benefit of diversification and easier trade execution through the ETF structure. Benefits of SGOV. Targeted exposure. SGOV focuses specifically on the ultra-short end of the Treasury market, providing a way to play interest rate fluctuations within that specific segment. Stability. Short-term treasuries are generally considered one of the safest fixed-income investments due to the backing of the U.S. government. SGOV inherits this stability, making it suitable for investors seeking to preserve capital. Cash management. SGOV can be a good option for parking idle cash and potentially earning a small return compared to keeping it in a checking account. Things to consider. Interest rate sensitivity. While treasuries are considered safe, their prices are inversely proportional to interest rates. If interest rates rise, the price of SGOV can decline. Low returns. Short-term treasuries typically offer lower returns compared to longer-term bonds or stocks. SGOV reflects this by providing a steady but limited income stream. Liquidity. SGOV, being an ETF, trades throughout the day like a stock, offering good liquidity compared to directly buying individual treasuries. In essence, SGOV is a tool for investors seeking low-risk exposure to the U.S. Treasury market. A way to manage short-term cash holdings. Potential portfolio stability during market volatility. When was SGOV launched, and what was the rationale behind its creation? The iShares 0 to 3 month Treasury Bond ETF, SGOV, was launched on May 26, 2020. The rationale behind its creation can be understood by considering a few key factors in the financial landscape at that time. Market conditions. Interest rate environment. In 2020, the Federal Reserve had slashed interest rates to near zero levels in response to the economic slowdown caused by the COVID-19 pandemic. This meant that yields on traditional fixed-income investments, like longer-term bonds, were also very low. Increased demand for short-term investments. In such a low interest rate environment, investors seeking safety and a modest return turned to short-term investments like cash equivalents and money market funds. SGOV offered an alternative to these options. Benefits of SGOV. Targeted exposure. Prior to SGOV, there weren't many exchange-traded options for investors specifically interested in the ultra-short segment, maturities of 3 months or less, of the Treasury market. SGOV filled this gap by providing a convenient way to gain exposure to this specific area. Potential for higher returns. While money market funds and cash equivalents offered some level of safety, their returns were typically very low. Short-term treasuries, on the other hand, could potentially offer slightly higher returns, and SGOV provided access to a basket of these bonds. Liquidity and transparency. SGOV, being an ETF, trades on an exchange throughout the day, offering greater liquidity compared to directly buying individual short-term treasuries. Additionally, the holdings of SGOV are transparent, allowing investors to understand the underlying composition of the ETF. Overall, the launch of SGOV in 2020 aimed to cater to investors seeking a safe and liquid investment option in a low-interest rate environment. Targeted exposure to the ultra-short segment of the Treasury market with potentially slightly higher returns compared to traditional cash equivalents. Transparency and ease of trade through the ETF structure. Is SGOV designed to track a specific bond index? If so, which one? Yes, SGOV is designed to track a specific bond index. The most likely index it tracks is the Bloomberg Barclays US Treasury Bills 0 to 3-month index. Here's a breakdown of why. Focus on short-term treasuries. Both SGOV and the Bloomberg Barclays US Treasury Bills 0 to 3-month index focus exclusively on US Treasury bills with maturities of 3 months or less. This aligns with SGOV's stated objective of providing exposure to this specific segment of the Treasury market. Industry standard, the Bloomberg Barclays US Treasury Bills 0 to 3-month index is a widely recognized benchmark for short-term Treasury performance. By tracking this index, SGOV offers investors a way to compare its performance to a well-established measure of the market it targets. However, it's crucial to note that the issuer of SGOV, iShares, doesn't explicitly state on their website which specific index the ETF tracks. While the Bloomberg Barclays US Treasury Bills 0 to 3-month index is the most likely candidate, there's a possibility that SGOV tracks a proprietary index developed by iShares that achieves a similar objective. Here's how you can confirm the specific index. Fund documentation. Look for the fund prospectus or fact sheet for SGOV. These documents often disclose the benchmark index the ETF tracks. You can find them on the iShares website or through financial data providers. Contact iShares Investor Relations. You can directly contact iShares Investor Relations and inquire about the specific index SGOV tracks. Understanding the underlying index is important because it provides insight into the specific selection criteria and methodology used to choose the treasuries held by SGOV. This can help you assess how closely the ETF reflects the performance of the broader short-term treasury market segment. How does SGOV achieve its investment objective of providing exposure to short-term treasury bonds? SGOV achieves its objective of providing exposure to short-term treasury bonds through a combination of passive management and by holding a basket of these bonds that reflects the underlying index it tracks, most likely the Bloomberg Barclays US Treasury Bills 0 to 3-month index. Here's a breakdown of the process. Passive management. Unlike actively managed funds that try to outperform the market by selecting specific bonds, SGOV employs a passive management strategy. This means it aims to replicate the performance of the underlying index by holding the same, or a statistically similar, basket of short-term treasuries as the index. To achieve this, SGOV doesn't engage in security selection or attempt to time the market. Instead, it focuses on replicating the weightings of each treasury bill within the index. Holding a basket of treasuries. SGOV achieves diversification by holding a basket of short-term treasuries with maturities of 3 months or less. This helps to spread out risk and reduces the impact of any single security on the overall performance of the ETF. The specific treasuries held by SGOV are typically determined by the composition of the underlying index. The index provider uses a set of criteria, like remaining maturity and credit quality, to select the treasuries that make up the index. SGOV replicates the index by holding these treasuries in proportion to their weighting within the index. For example, if a specific treasury bill represents 5% of the index, SGOV will hold a proportional amount of that bill to achieve a similar weight in the ETF's portfolio. Additional considerations. Rebalancing. The holdings of SGOV are periodically rebalanced to ensure they continue to reflect the weightings of the underlying index. This process may involve buying or selling certain treasuries to maintain the desired exposure. Cash equivalents. It's important to note that SGOV may hold a small amount of cash equivalents, like money market instruments, to manage cash flows between rebalancing dates or to meet operational needs. However, the primary focus remains on holding short-term treasuries. What is the average maturity of the bonds held by SGOV? How does this maturity range compared to other short-term bond ETFs? Average maturity of SGOV in comparison to other short-term bond ETFs. SGOV. The average maturity of the bonds held by SGOV is exceptionally short, targeting around 0.09 years, approximately 34 days. This aligns with its objective of focusing on the ultra-short end of the Treasury market, maturities of 3 months or less. Comparison to other short-term bond ETFs. While SGOV boasts the shortest average maturity, other short-term bond ETFs can have varying maturities depending on their specific investment strategy. Here's a breakdown of some common categories. Ultra-short bond ETFs. These ETFs, like SGOV, focus on the very short end of the maturity spectrum. They may have average maturities ranging from a few days to a few months. Examples include SPDR Barclays 1 to 3 month T-bill ETF, SHV, targets 1 to 3 month maturities. Short-term bond ETFs. These ETFs offer exposure to a broader range of short-term bonds, typically with average maturities ranging from 1 to 3 years. Examples include iShares Short Treasury Bond ETF, SHRT, targets maturities of 1 to 3 years. Vanguard Short-Term Treasury ETF, VGSH, targets maturities of 1 to 3 years. Intermediate-term bond ETFs. While not strictly short-term, some investors might consider including intermediate-term bond ETFs, maturities of 3 to 10 years, for comparison, especially in a low-interest rate environment. However, their average maturity will be significantly higher than SGOV. Examples include iShares Intermediate Treasury Bond ETF, INTM, targets maturities of 3 to 10 years. Vanguard Intermediate Term Treasury ETF, VGIT, targets maturities of 3 to 10 years. Key takeaways. SGOV stands out for its ultra-short focus, offering the lowest average maturity among commonly compared short-term bond ETFs. Investors seeking slightly more exposure to the short-term Treasury market with potentially a bit higher return, due to slightly longer maturities, can explore other short-term bond ETFs like SHV, SHRT, or VGSH. The choice between different short-term bond ETFs depends on your specific investment goals and risk tolerance. If you prioritize capital preservation and minimal interest rate risk, SGOV's ultra-short maturity can be appealing. However, if you're comfortable with slightly more risk for potentially higher returns, you might consider ETFs with slightly longer maturities. Does SGOV employ any active management strategies, or is it passively managed? SGOV is a passively managed ETF. Here's a breakdown of what that means and how it applies to SGOV. Passive management versus active management. Passive management. In passive management, the fund manager doesn't try to outperform the market by selecting specific securities. Instead, the goal is to replicate the performance of a chosen benchmark index. This is often achieved by holding the same, or a statistically similar, basket of securities as the index. Passive management typically comes with lower fees compared to actively managed funds. Active management. In active management, the fund manager attempts to outperform the market by selecting securities they believe will generate higher returns than the benchmark index. This involves ongoing research, analysis, and portfolio adjustments based on market conditions. Actively managed funds typically have higher fees to cover the costs associated with this approach. How passive management applies to SGOV. SGOV tracks a specific bond index, most likely the Bloomberg Barclays US Treasury Bills 0 to 3-month index. The fund manager doesn't actively pick individual short-term treasuries. Instead, they focus on replicating the weightings of each treasury bill within the index. SGOV achieves this by holding a basket of short-term treasuries with maturities of 3 months or less, where the proportion of each treasury reflects its weight in the underlying index. There is no attempt to time the market or select specific treasuries based on perceived value. The focus is on passively mirroring the performance of the chosen index. Benefits of passive management for SGOV. Lower fees. Passive management generally comes with lower fees compared to actively managed funds. This can be beneficial for investors seeking a cost-effective way to gain exposure to the short-term treasury market. Transparency. The holdings of SGOV are typically transparent, allowing investors to understand the underlying composition of the ETF and how it tracks the index. Diversification. By holding a basket of short-term treasuries, SGOV offers diversification and reduces the impact of any single security on the overall performance of the ETF. How sensitive is the price of SGOV to changes in interest rates? The price of SGOV, an ETF that holds short-term treasuries, is inversely proportional to interest rates. Here's why. When interest rates decrease, the price of SGOV tends to increase. Investors seeking higher returns may turn to short-term treasuries as other fixed-income options become less attractive. Increased demand for these treasuries can drive their prices up, and as SGOV holds a basket of these bonds, its price reflects this movement. Conversely, when interest rates rise, the price of SGOV tends to decrease. Investors may find newly issued treasuries with higher yields more appealing, reducing demand for existing short-term treasuries. As the price of the underlying treasuries held by SGOV falls, the price of the ETF itself is likely to follow suit. How does SGOV manage credit risk, given that it invests solely in US Treasuries? SGOV manages credit risk in a unique way compared to most ETFs due to its exclusive investment in US Treasuries. Here's a breakdown. Why US Treasuries have minimal credit risk. Government backing. US Treasuries are issued by the US government, considered one of the safest borrowers globally. This means there's an extremely low chance of the government defaulting on its debt obligations, significantly reducing credit risk for investors in SGOV. Full faith and credit. The US government has the full faith and credit of the US Treasury to back its debt. This implies the government can raise taxes or print money, as a last resort, to fulfill its debt obligations. How SGOV benefits from minimal credit risk. Low default risk. Since SGOV holds only treasuries, the risk of individual bond issuers defaulting is practically eliminated. This translates to a high degree of safety for investors seeking capital preservation. Investment grade rating. US Treasuries consistently receive the highest credit ratings, AAA, from major credit rating agencies, further solidifying their creditworthiness. Nuances to consider. Inflation risk. While default risk is minimal, holding treasuries exposes investors to inflation risk. As inflation rises, the purchasing power of the fixed interest payments from treasuries held by SGOV can erode. Liquidity risk. Although US Treasuries are generally highly liquid, there's a small possibility of temporary liquidity issues during periods of extreme market stress. However, for SGOV, being an ETF itself adds an additional layer of liquidity as investors can easily buy or sell shares on an exchange. How has SGOV performed during periods of market volatility? Understanding how SGOV performs during market volatility requires considering its unique characteristics. Focus on short-term treasuries. SGOV holds bonds with maturities of 3 months or less. These short-term treasuries are generally considered less volatile than longer-term bonds or stocks. Inverse relationship with interest rates. The price of SGOV moves inversely to interest rates. When markets experience volatility and investors seek safe havens, the demand for treasuries can rise, potentially pushing up the price of SGOV if interest rates fall. Potential benefits during market volatility. Relative stability. Compared to equities or longer-term bonds, SGOV may offer more stability during market downturns. The short maturities of the underlying treasuries reduce their sensitivity to interest rate changes, potentially mitigating price swings. Potential for price appreciation. If market volatility leads to a decrease in interest rates, SGOV could benefit from the corresponding rise in the prices of short-term treasuries. This can provide some capital preservation and even potential for price appreciation for SGOV itself. Limitations to consider. Limited returns. While SGOV may offer stability, its potential returns are typically lower compared to stocks or even some longer-term bond funds. This is because short-term treasuries generally offer lower interest rates. Sensitivity to interest rate changes. Despite its relative stability, SGOV is not entirely immune to interest rate movements. If interest rates rise significantly during market volatility, the price of SGOV could still decline. What are the expense ratios associated with investing in SGOV? The expense ratio associated with investing in SGOV is a crucial factor to consider, as it directly impacts your returns. Here's a breakdown of the expense ratios for SGOV. Net expense ratio. This is the primary expense ratio to focus on. It represents the annual ongoing fees charged by the ETFs issuer, iShares, to cover operational costs, management fees, and other administrative expenses. As of June 2, 2024, the net expense ratio for SGOV is 0.13%. Breakdown of expense components. While the net expense ratio is the headline figure, it can be further broken down into some underlying components. Management fee. This fee compensates iShares for managing the ETF and ensuring it tracks its underlying index. Acquired fund fees and expenses. These represent fees associated with holding the underlying treasuries within the ETF. These fees are typically minimal for US Treasuries. Other expenses. This category may include additional operational costs associated with running the ETF. Importance of expense ratios. Impact on returns. Expense ratios directly eat into your investment returns. A lower expense ratio translates to a higher net return for you. Comparison with alternatives. When considering SGOV, it's important to compare its expense ratio to other short-term bond ETFs or even alternative investments like money market funds. A lower expense ratio can give SGOV a competitive edge. Does SGOV distribute dividends, and if so, how frequently? Yes, SGOV does distribute dividends, and the frequency is typically monthly. Here's a breakdown of how SGOV distributes dividends. Source of dividends. SGOV earns income from the interest payments on the short-term treasuries it holds. These interest payments are typically distributed to shareholders as dividends on a regular basis. Frequency of distributions. Most short-term bond ETFs, including SGOV, distribute dividends monthly. This provides investors with a predictable stream of income. Dividend payment dates. The exact date for SGOV's dividend payments can vary. However, the issuer, iShares, typically announces the upcoming dividend amount and payment date in advance. You can find this information on the iShares website or through financial data providers. Tax implications of dividends. Dividends from SGOV are generally considered interest income for tax purposes. The specific tax treatment will depend on your individual tax situation and the type of account you hold SGOV in, taxable versus tax-advantaged. Consulting with a tax advisor is recommended for specific advice. Understanding dividend yields. It's important to distinguish between the dividend frequency, monthly, and the dividend yield. The dividend yield represents the annualized dividend amount expressed as a percentage of the current ETF share price. This metric provides a sense of the potential income you can expect from SGOV relative to its current price. Does SGOV hold any significant amount of off-the-run treasuries? If so, how can this impact liquidity? Here's a detailed explanation of how SGOV handles off-the-run treasuries and the potential impact on liquidity. Off-the-run treasuries and SGOV. Focus on the run. SGOV primarily aims to track an index composed of the most recently issued short-term treasuries, typically with maturities of 3 months or less. These are referred to as on-the-run treasuries. Limited off-the-run exposure. While SGOV might hold a small portion of off-the-run treasuries, previously issued treasuries with maturities less than 3 months, their presence is likely minimal due to the ETF's focus on-the-run issues. Impact of off-the-run treasuries on liquidity. Generally less liquid, off-the-run treasuries tend to be less liquid compared to on-the-run issues. This means there may be fewer buyers and sellers actively trading them, potentially leading to wider bid-ask spreads and slower execution times. Minimal impact for SGOV. Due to the likely minimal holdings of off-the-run treasuries in SGOV, their impact on the overall liquidity of the ETF is likely negligible. ETF structure enhances liquidity. As an ETF, SGOV itself trades on an exchange throughout the day, offering investors a more liquid way to enter and exit their positions compared to directly buying and selling individual short-term treasuries. Overall, while off-the-run treasuries can be less liquid, their minimal presence in SGOV is unlikely to significantly impact the ETF's overall liquidity. The ETF structure itself provides a readily tradable vehicle for investors seeking exposure to the short-term treasury market. What is the turnover rate of the holdings within SGOV? The turnover rate of the holdings within SGOV refers to the frequency at which the underlying treasuries in the ETF are bought and sold. Here's a breakdown of how this applies to SGOV. Low turnover expected for SGOV. Due to its focus on short-term treasuries with maturities of 3 months or less, SGOV is expected to have a relatively low portfolio turnover rate. This means the holdings within the ETF are likely to be adjusted infrequently. Reasons for low turnover. Short maturities. Since the underlying treasuries held by SGOV mature relatively quickly, within 3 months, there's less need for frequent buying and selling to maintain the desired exposure to the short-term treasury market. Passive management. As a passively managed ETF, SGOV aims to track a specific index. This typically involves holding the same, or a statistically similar, basket of treasuries as the index, leading to less frequent changes compared to actively managed funds. Benefits of low turnover. Lower transaction costs. Lower portfolio turnover translates to fewer transaction costs associated with buying and selling treasuries. This helps to preserve returns for SGOV investors. Tax efficiency. Less frequent trading activity within the ETF generally results in lower capital gains distributions for investors holding SGOV in taxable accounts. Potential drawbacks of low turnover. Tracking error. While infrequent trading keeps costs low, it can lead to a slight tracking error. This means the performance of SGOV might not perfectly mirror the underlying index due to timing differences between the ETF's adjustments and index movements. However, for short-term treasuries with minimal price fluctuations, this tracking error is likely to be negligible. How does SGOV compare to other short-term bond ETFs in terms of fees, expense ratios, and liquidity? Here's a comprehensive comparison of SGOV to other short-term bond ETFs in terms of fees, expense ratios, and liquidity. Fees and expense ratios. SGOV, as of June 2, 2024, SGOV has a net expense ratio of 0.13%. This falls within the typical range for passively managed short-term bond ETFs. Alternatives. Other short-term bond ETFs may have slightly lower or higher expense ratios. It's crucial to compare specific options like SPDR Barclays 1 to 3 month T-bill ETF, SHV expense ratio might be comparable or slightly higher than SGOV. iShares Short Treasury Bond ETF, SHRT, targets 1 to 3 year maturities, so the expense ratio might be slightly higher than SGOV due to potentially more complex management. Liquidity. SGOV benefits from being an ETF itself, offering investors a readily tradable vehicle on exchanges throughout the day. Alternatives. Liquidity can vary depending on the specific ETF and the underlying holdings. Here's a breakdown. SHV, likely to have high liquidity, due to its focus on similar ultrashort maturities as SGOV. SHRT, while still an ETF, holding slightly longer maturities, 1 to 3 years, could lead to slightly lower liquidity compared to SGOV or SHV. Are there any actively managed short-term bond funds that could potentially outperform SGOV? Yes, there is a possibility that some actively managed short-term bond funds could outperform SGOV, iShares 0 to 3 month Treasury Bond ETF. Here's a breakdown of the factors to consider. SGOV's investment strategy. SGOV is a passively managed ETF that tracks a specific index, aiming to replicate its performance. This means it doesn't attempt to outperform the market by selecting specific bonds. Potential advantages of actively managed funds. Security selection. Actively managed funds employ fund managers who research and select individual bonds within the short-term maturity range. These managers may aim to identify undervalued bonds or capitalize on specific market inefficiencies, potentially leading to returns exceeding the benchmark index. Interest rate management. Active managers can potentially adjust the portfolio based on their interest rate outlook. They might favor bonds with maturities that benefit from anticipated interest rate movements, aiming to enhance returns compared to a passively managed option. How do high-yield savings accounts compare to SGOV in terms of risk and return? Here's a comprehensive comparison of high-yield savings accounts and SGOV, iShares 0 to 3 month Treasury Bond ETF, in terms of risk and return. Risk. High-yield savings accounts. Low credit risk. Deposits in insured accounts are typically FDIC insured up to $250,000 per depositor, significantly mitigating credit risk. Interest rate risk. Returns are primarily dependent on the offered interest rate, which can fluctuate based on market conditions. However, the fluctuations are generally smaller compared to bond funds. Inflation risk. The interest earned might not keep pace with inflation, potentially eroding purchasing power over time. SGOV. Minimal credit risk. SGOV invests solely in US Treasuries, considered one of the safest asset classes with exceptionally low default risk. Interest rate risk. The price of SGOV is inversely proportional to interest rates. When interest rates rise, the price of SGOV can decline, and vice versa. However, due to the short maturities, 0 to 3 months, held by SGOV, this interest rate sensitivity is generally lower compared to longer-term bond funds. Market volatility risk. While less volatile than stocks, SGOV's price can experience some fluctuations during periods of market turbulence. Return. High-yield savings accounts. Generally lower returns. High-yield savings accounts typically offer lower interest rates compared to bond funds or the stock market. However, the returns are typically more predictable and less volatile. SGOV. Potentially higher returns. SGOV, as an ETF, has the potential for higher returns than high-yield savings accounts, especially in rising interest rate environments. However, these returns can fluctuate based on market movements. Can Treasury bills be a viable alternative to investing in SGOV? Yes, Treasury bills, T-bills, can be a viable alternative to investing in SGOV, iShares 0 to 3 month Treasury bond ETF, depending on your investment goals and priorities. Here's a breakdown of the key factors to consider. Similarities. Investment in US Treasuries. Both T-bills and SGOV offer exposure to US Treasuries, considered one of the safest asset classes with minimal credit risk. Focus on short-term maturities. Both options typically focus on short-term maturities, offering predictable returns and relative stability compared to longer-term bonds or stocks. Differences. Investment structure. T-bills, direct investments in individual Treasury bills through auctions held by the U.S. Department of the Treasury. SGOV, an ETF that holds a basket of short-term Treasuries, offering diversification and convenience of buying/selling on an exchange. Fees. T-bills have no inherent fees, while SGOV has a net expense ratio that eats into returns. Liquidity. T-bills can be less liquid than SGOV, especially for shorter maturities. Selling them before maturity might require accepting a discount on the face value. SGOV offers easier entry and exit points through exchange trading. Interest rate determination. T-bills. Investors earn the interest rate established at the auction where they purchase the T-bill. SGOV. The effective yield reflects the combined interest earned by the underlying treasuries held by the ETF, potentially influenced by the ETF's expense ratio. Choosing between T-bills and SGOV. Convenience and diversification. If you prioritize convenience, diversification, and a readily tradable option, SGOV might be a better choice despite the expense ratio. Minimal fees and control. If minimizing fees and having complete control over the specific maturity of your investment are priorities, then directly buying T-bills through auctions could be more suitable. However, be aware of potential limitations in liquidity. How do money market funds compare to SGOV in terms of risk and return? Here's a comprehensive comparison of money market funds and SGOV, iShares 0 to 3 month Treasury bond ETF, in terms of risk and return. Risk. Money market funds. Very low credit risk. These funds primarily invest in high-quality, short-term debt instruments like Treasury bills, certificates of deposit, CDs, and commercial paper. This minimizes credit risk. Interest rate risk. Returns are primarily dependent on the prevailing interest rates, which can fluctuate. However, these fluctuations are typically smaller compared to bond funds. NAV fluctuations. Unlike traditional mutual funds, money market funds typically maintain a $1.00 share price. However, in rare instances, the net asset value, NAV, might fluctuate slightly, leading to minor principal value changes. SGOV. Minimal credit risk. SGOV invests solely in US Treasuries, considered one of the safest asset classes with exceptionally low default risk. Interest rate risk. The price of SGOV is inversely proportional to interest rates. When interest rates rise, the price of SGOV can decline, and vice versa. However, due to the short maturities, 0 to 3 months, held by SGOV, this interest rate sensitivity is generally lower compared to longer-term bond funds. Market volatility risk. While less volatile than stocks, SGOV's price can experience some fluctuations during periods of market turbulence. Return. Money market funds. Generally lower returns. Money market funds typically offer lower returns compared to bond funds or the stock market. However, the returns are typically more predictable and less volatile. SGOV. Potentially higher returns. SGOV, as an ETF, has the potential for higher returns than money market funds, especially in rising interest rate environments. However, these returns can fluctuate based on market movements. Choosing between money market funds and SGOV. Ultra-safe parking spot. If your primary concern is capital preservation and absolute minimal risk, a money market fund might be a better choice, especially for short-term savings goals. Seeking some potential upside. If you're comfortable with a touch more risk and are looking for the potential for slightly higher returns than a money market fund, SGOV could be a good option. However, remember that the value of your investment in SGOV can fluctuate, unlike a money market fund maintaining a $1.00 share price. Additional considerations. Liquidity. Both money market funds and SGOV are generally considered highly liquid investments. Money market funds typically offer check writing access for convenient withdrawals, while SGOV offers daily trading on exchanges. Fees. Money market funds may have expense ratios, although typically lower than SGOVs. Some money market funds might also have redemption fees if you withdraw funds within a certain time frame. Alright, so we've reached the end of our SGOV exploration. To wrap it up, remember, SGOV isn't a one-size-fits-all solution. If ultra safety is your top priority, a high-yield savings account or money market fund might still be the way to go. But for those willing to accept a touch more risk for potentially higher returns, SGOV could be a compelling option, especially when compared to traditional savings options. Before you jump in, remember to consider your investment goals, risk tolerance, and time horizon. And as always, do your own research to see if SGOV aligns with your financial strategy. Thanks for joining me today. If you found this video helpful, hit that like button and subscribe for more investment breakdowns. I'll see you in the next one.